Welcome to the Snowbirds Expat Radio podcast, powered by the Snowbird US Day Tracker app. I'm your host, Gerry Scott, and my goal is to give you answers to your cross-border questions, to ease the stress of a cross-border move or extended trip, and to keep you up to date on all you need to know with cross-border rules and regulations. Now let's get on with the show. Well, hello everybody. Welcome to the Snowbird Expat Radio podcast. We've got a returning guest / co-host, Steven Flynn from Anderson. We've had a chance to spend a lot of time together the last little while here, and I believe we do have a golf game coming up at Richmond. So we're looking forward.
It's our turn to host. Yep.
That's right. And also we have a co-sponsored event that we're doing in the fall as well. So we're fortunate to be able to get a lot of time and resources from our good friend here, Mr. Flynn. But today we're going to be covering something that's really in the news. There's so many articles out there, Steve, right now with all these Canadians selling homes in all the popular states, maybe Arizona. We're not seeing it in Maui, but we are seeing it in Florida, the Carolinas. Canadians are selling their homes. I think the last article I read late last night was this time last year in the state of Arizona. There was 700 homes being sold by Canadians, and a year ago it was 100. So this is a very timely topic, and I do have one of the experts who's going to walk us through the selling and all the things that you need to be concerned about, tax implications, holding funds back, the states that hold the money back. So Steve, welcome to the show, and I believe this is your 5th time you've been on this world-class podcast.
It is. Yeah, I'm happy to be back here for my 5th appearance, Gerry. I might have been the inaugural guest. One would have to go through the voluminous podcast you've had with some great topics, but happy to be on the 5th one. And it is quite an interesting topic. We saw this probably 5 years ago when the pandemic came in and people couldn't travel to the US. And at the same time, there was this heated demand for properties in some of the Sunbelt states. And so Canadians were incentivized for a number of reasons to sell. And you kind of see some of the same factors again.
Well, I also believe that, the Canadian dollar, which has rallied with the tariffs being suspended for 90 days or put off for 90 days. So we saw the Canadian dollar going from the high 68s all the way up to, I think, it was actually down 36 basis points today, but it's still at 72 cents, which doesn't sound like a lot. So a lot of people are blaming this on political noise, but we'll get into it. So Steve, I've got 10 questions for you. Actually, I got 9 questions for you. I'm going to give you a break because you are a 5-time host and the first 5-time guest, sorry. And I've told many people that they were the first on the podcast. So, okay. So here we are. Let's jump right into it. So with the tensions between Canada and the United States, how many Canadians how are they feeling about their snowbird nest down in the States right now?
Well, I think there's a number of challenges. And I think it starts probably well before Trump was elected. When you look at some of the weather events and some of the significant issues that have happened in Florida, in California, and some, people are looking at their properties and the insurance premiums have gone significantly higher if they can get insurance covers that covers it all. It gives some Canadians a lot of pause to say, well, I put a lot of money and time and love into these places. And am I in a place where a hurricane could hit me or a wildfire? And so that's kind of one of the factors. I think another one I've heard and understand is over time, as the Canadian dollar weakens, and it might have been up, as you said, the last couple of weeks, but when you look at, 3-4 years ago when we were at $1, say 15 or $1.20, to buy a US dollar, and now we're $1.40 to $1.45. Your annual running costs to pay property taxes and insurance and maintenance fees and condo fees and all the upkeep, it just becomes that much more expensive. And when you factor in the last couple of months of a trade war, economic uncertainty, are Canadians feeling comfortable in the US? Are they satisfied with what's going on, or do they want to make a statement? A lot of these things are kind of put together where a lot of Canadian families now say maybe it's time to exit the US and sell that great townhome we had in Arizona or that great condo we had on the coast of Florida.
Well, just some of the conversations we had. We arrived back in Canada late March, and one of our friends who lives on the high side of Lahaina, there's a bypass there, and there's a real fancy development. I think they've got about 2 acres. Is their property? Their homes is probably worth $5 or $6 million. I believe that we were told that they were paying $50,000 in insurance costs, and the property taxes have skyrocketed as well. So the stories are real, and you're right. It's getting difficult for Canadians to live that wonderful lifestyle. So let's jump right into tax. What are some of the U.S. federal tax issues for Canadians that are selling their properties?
Sure. So what Canadians have to understand, and if this is someone who's not a U.S. citizen, who doesn't have a U.S. green card, who, they're down there on some sort of visa, or they're down there as a visitor. If they sell U.S. real property interests, the U.S. federal government wants to make sure they pay tax on whatever net gain they may have on the property. And so on closing, they'll get a question asked by the escrow agency. They'll ask if they're a U.S. person, and when they answer that they're not, the U.S. federal government comes in, and there's something called the Foreign Income and Real Property Tax Act that basically says there's a withholding tax on the gross purchase price, the gross sales price, if you will, of the property. And it varies depending on the amount of the price. It could be 10%, it could be as high as 15%. And that's for federal taxes, and that's on the gross. And for a lot of people, they may have an appreciation on the value. They may have bought it for, say, $1 million, and now they're selling it for $1.5 million. And so they got a $500,000 gain that is subject to tax. But that withholding tax, because it's calculated on the gross sales price, so the 1.5 million, oftentimes that U.S. federal withholding is far higher than the actual U.S. federal tax would be on the return. And that's by design, so that it compels people to then have to come forward to the IRS, report the sale, report the gain, report the amount of tax withheld. It forces them to file a tax return.
Well, that's like you say, that's 15%. It's interesting because we just been taking this little tax course that Raymond James put on to us. Any of these advisors that are working on both sides of the border, we got to get you guys as much as we knew about this, because I have friends like Steve who's educated us. It's very interesting. These are all the things that are being covered. Now, it's the in this situation, it's who's responsible for making sure that you are a foreign, a non-resident that's selling the property. Whose responsibility is that?
Yeah, that's a good question. So it's really the buyer, and the buyer, through the escrow agent or through the representatives, has an obligation to ask that question. That the seller, and what is their U.S. status. And so there's a form that gets completed. There are documents that come on closing, and if you are a U.S. person, a U.S. citizen, or a U.S. resident, or a U.S. green card holder, you can provide them information that proves that, and you'd have to provide them your social security number. You'd have to sign an affidavit saying I am a U.S. person, and then if you are, then there is no withholding tax federally, regardless, because if you're already a U.S. person, you're filing an annual income tax return, you're reporting and paying U.S. federal tax on your worldwide income. The escrow agent will produce a tax slip for you with your name on it, and the proceeds you have on sale. It's commonly called a 1099. Again, if you are a U.S. person, that's what we're produced. But for most Canadians, if they're not U.S. persons, then it's a very different process. And so it's the responsibility of the buyer or the escrow agent who's going to close it, who's going to help document the close of the transaction, that takes on that responsibility.
So this is the 15% is federal?
The 15% is federal. And so the U.S. is a bit different than Canada, because in Canada, we combine, in general terms for individuals, our federal tax and our provincial tax into one tax return, into kind of one rate and one kind of filing. The U.S. is very different. Federal tax covers the U.S. federal government. Each state has its own way of taxing individuals. And when you sell real estate in that state, you could be subject to state income tax as well. And on closing, depending on the state, you could be subject to withholding at the time of closing. For example, California, if you sell property anywhere in the state of California, there's a withholding of 3 1/3% on the gross on any property sold in California. Now, there's representations you can make to reduce that. But that's how California handles it. Hawaii has something similar. In contrast, Florida doesn't have an individual income tax, so there is no withholding tax in the state of Florida for property stolen in Florida.
So the average person, they sell this home for $1 million. They have a capital gain on that property, and they've got this $150,000 US that's withheld. How do they get that money back? What do they need to do, and how long does it take?
Well, that's a good question. So lots there. So basically, and I'll use the example of a Canadian who's not a U.S. citizen, not a U.S. green card holder or a U.S. resident. So a Canadian who is selling the property, that 15% federal and whatever it is state, when you do the calculations, almost 95, 99% of the time, it's going to be higher than the actual tax on the gain, because the tax on the gain for federal tax purposes, your maximum tax rate's 20%. And that's calculated on the difference between what you sell it for and what you paid for it. And you can also deduct off that gain real estate expenses, real estate commissions, if you paid lawyers' fees to close the property, if you put investments into the property, you put a new roof on the place, you made renovations, all those things can increase your cost basis in the property, decrease that gain. But inevitably that withholding tax is going to be higher at closing than it ever is in the gain. And so it compels you to file an income tax return to the Internal Revenue Service to report both the gain, the tax, and then the over withholding to request a refund from the IRS, which for a lot of Canadians is a very unusual experience. They may have never had to file a U.S. tax return before, so it is very unique and very different.
Now, we had clients that were selling places on the base of Mount Baker, and the price was these cabins, and this is going back about 10 years ago, or maybe even just 8 or 9 years ago. But they were selling these cabins for like less than $300,000. Is there a threshold where the 15% doesn't get withheld?
So there can be, in certain circumstances, if the selling price of the property is $300,000 or less, and if the buyer represents that they're going to use that property as their primary residence, and they have to put that in writing and sign an affidavit to that basis, then in those situations, there would be no withholding tax. And so that's going to make it easier for sellers, to get their full refund, their full proceeds back. In theory, they would still have to file a tax return because there could be a gain on the property, but there wouldn't be any withholding tax in that situation.
So that's a Canadian seller and American buyer with the intentions of living in that home. 50%.
Yeah, I guess it could be an American buyer. Typically, it could be a Canadian buyer that says, I'm moving to the U.S., but I'm going to occupy this as my primary residence. So you're not limited. The key there is it has to be their primary residence. The buyer can't be someone who's going to use it as a vacation property or use it as a rental property. You'd still have the withholding tax in that case.
Okay, so I sold my place in the United States, and I'm a Canadian. Now I have to report that gain on the Canadian side.
Well, that's right. I mean, if it was bad enough that the U.S. federal government wants to tax it, or maybe one of the states taxes it, there's a third tax authority because you're a resident of Canada. And in Canada, you're taxed on your worldwide income and your world gains. That includes any gain you have on the sale of U.S. real estate. And, what you have to take into account is a couple of things. One is you may have a gain in U.S. dollars. So if you bought it for $1 million US and sold it for $1.5 million, you got a $500,000 gain. What you also have to remember from a Canadian perspective is that this is all transacted in US dollars, and you have to translate whatever you did from US dollars into Canadian dollars based on the exchange rate at the time you did something. And what catches people sometimes is that there may not only be a capital gain in US dollars, but there may be what's called a foreign exchange gain in Canadian dollars. For example, take that same scenario I laid out for you. If you paid $1 million for that place in 2013, let's say, and I picked that year because I think the Canadian dollar was at par with the US dollars. So $1 million US is $1 million Canadian. That's your cost basis for Canadian tax purposes. If you sell it for $1.5 million, and let's say the exchange rate was 1.4, and doing the math, let's say that's $2.1 million Canadian. Your gain is actually the 2.1 Canadian dollars you realize less the $1 million you paid in Canadian dollars. Your gain is 1.1 million Canadian, even though your gain is only 500,000 US dollars. So that foreign exchange gain is part of the transaction. You just got to take that into account.
You know, it's interesting. You sell a place in Canada, maybe your principal residence. The first thing you do is you talk with your spouse and you say, listen, I think it's time for us to sell, move on. You call a realtor. In the United States, the biggest takeaway from today's podcast is you need to call that accountant first. May it be a Steve Flynn. You're the person that really should be the first person they talk to, because the tax implications, the withholdings, it's crazy, isn't it?
Well, it's a unique because it's new for a lot of Canadians because they don't have a connection with the U.S. They may have never worked in the U.S. or maybe they worked there 30 years ago and they have a social security number, but they can't find it. Or maybe they've been an investor in the U.S. and they had what's called a taxpayer number. The idea here is that when you're transacting with the Internal Revenue Service, you can't use your existing Canadian data to help. You've got to apply for a new kind of identification number that tells the IRS, this is who this individual is, this is their new 9-digit number, this is the number that they're going to use when they file US tax returns. And it's a very different process. And it's, depending on your circumstances, it isn't a place where you can just go to the IRS website and click a few buttons and get an individual taxpayer number. It's quite an involved process. The IRS really wants to know who you are, and they want proof of who you say you are. There's been millions of claims of kind of fraudulent tax returns, dependents that never existed. And so the IRS over the last 20 years has made it a very, robust process to get an individual taxpayer identification number, something you need to file a tax return. You actually have to get someone to certify your identification. If you're a Canadian, to certify your passport to say, yes, that's who you are. I am one of those people. It's called a certifying acceptance agent. We got 3 or 4 in the office here at Anderson, and we have to go through the passport. We have to fill in certain forms to the IRS, even just before you start the process, to say, yes, this is who this is, just to get you that number to get you started.
Now, all this prep work that's required, how much time do you think a person has the interest to sell their place or have made that decision, how much time do they need to get all this planning done before they engage someone like yourself to help them through this process?
Well, it's a tough question to answer. It's the right question to answer. In an ideal world, we can help when you've got kind of 3 to 6 months before sale. If you know you're going to sell the property and you've done nothing in the U.S., some of the first steps you want to do is to, basically, understand how you hold the property. For a lot of people, it's pretty simple. It's in joint titles. Some people have it in entities. And so it's a matter of understanding, okay, what's the entity you hold the title in? Does this make sense to sell it into this entity? Can we transfer it or do something to make it make more sense, to be more tax efficient? If we don't have taxpayer numbers, or if we had them, but they expired, because typically in the US, every 3 years, you've got to renew them. Let's get that kind of started. If we can't get it done before closing, it's not a problem. You can always sell U.S. real property without any identification numbers. It just makes it easier if we can get it ahead of time, so that when you go to close and you work with the escrow agent, you can give them the full information, including your U.S. identifier number. That's just going to help the process with the IRS. We should talk a bit about that, because it is a challenging thing to go through with the IRS trying to get your refund.
So before both parties backed off, the Conservatives and the Liberals backed off on this tax that was supposed to be implemented January 1st, 2026, I believe it was, or was it 225, where you would have $250,000 would be tax free. Anything over and above that personally would be taxed at 66 2/3. How did that U.S. property, because I'm sure some folks did get caught up in this and were worried about this. Was that one of those assets that would be affected on a sale and as a capital gains in Canada?
In theory, it would have been. So going back to last year, in April of 2024, the Liberals announced that they were going to increase the capital gains tax rate from effectively a top rate in British Columbia of say 27%, or again, excluding an alternative minimum tax, let's say it's 27%. They were going to increase that rate to about 35, 36% with this capital gains rate inclusion. The Liberal government gave people kind of 10 weeks to kind of get their affairs in order to make a decision whether they wanted the old rate or the new rate to happen. And that magic date was June 24th. People made their decisions. And then through the next 6-9 months, as the Liberal government, fell apart in Canada, this capital gains tax rate just never got enacted. And then in January, February this year, all three parties, basically Liberals and the Conservatives both said, well, we're not going to enact this. So the capital gains rate increase kind of died. But what you were left with was if people actually had a transaction and sold it in 2024, they're stuck with it. That's part of the problems you had is people made those decisions. And so it would have had an impact. That's right.
So that if you paid all that capital gains, there is no recourse?
Well, in general, that's right. If you sold the property to a third party, I mean, the property's gone, you already realized the gain. I mean, I'm aware of some people that did transactions internally. They may have transferred property to a corporation or a partnership and then kind of held back on the transaction before filing everything. And when they realized that the capital gains rate didn't increase, they kind of scrapped the transaction. I mean, I'm aware of some of that probably would have happened. But if you actually went to a third party and sold it, it's too late. It's the transaction happened, and it's a shame that the planning you didn't need to do. And that's what a lot of people went through this year.
Okay, so let's say, for example, you sold your place early 2025. What can you do? So in 2025, our taxes aren't due until April 30th, 2026. What can those people do? Prepare their tax returns this year? What kind of planning can they do if they've already sold earlier this year?
Well, you just want to get yourself ready for the fact that you got to file U.S. federal returns. You may have to file state returns. And it's really just getting things kind of together now. So if you need a taxpayer number, it's good to apply for it now versus waiting until next year. It takes the IRS probably 6 to 8 weeks to issue that number. I anticipate it may take longer as the U.S. government tries to hire. They're freezing hiring in the IRS, and so you've got some people taking early packages. So it's just going to be a longer delay to get through the IRS. So applying for your taxpayer number now makes sense. Making sure all the documents you have that you're going to need are kind of lined up. And that's everything from looking through the escrow agent documents to say, okay, did everything get transaction the way it should? I always like to get involved with my clients before the transaction closes. It's a difficult industry the U.S. escrow agency has. It's low margin, high volume, tons of transactions, and a lot of pressure on it. And they don't often see Canadians selling property with withholding taxes. So that's a unique kind of a non-routine transaction, and it gets missed. It gets done improperly. Numbers get transposed. Buyers and sellers' names get confused. And what you'd hate to see is the escrow agent, transact the sale, close everything, complete the documents wrong, send checks to the wrong place or in the wrong amounts. And now you got to fight with the tax agencies, both federal and state, to figure out what money got sent where and try to apply it to your situation. So I always tell clients, have your accountant take a look at that, the one that's going to prepare that tax return. Have them take a look at it now and get in touch with the escrow agency. The kind of the ounce of prevention of some errors is worth that pound of cure down the road. So those are a couple things. In unique situations when entities own property, if we've had a couple situations like this in the last year where if we can change the year end of the entity, what we can do is instead of waiting till December 31st, 2025, and then January 26th and February 26th to file the U.S. tax return and get the refund, there's mechanics you can do when you have entities that own the property. If we can change the year end and say shorten the year end, we can file a return much sooner, and we can get that tax refund far sooner than say waiting till next year. And so those are some of the techniques and strategies you will often employ to try and help clients.
Steve, do you find that you sold your place, there's a huge capital gains, and let's say with your ITIN number, you're filing that U.S. tax return. What foreign tax credits are they carried forward on your U.S. return and on your Canadian return? And then the other thought that I have is on $1 million home, you're paying $150,000. How does that number come into play? Do you almost have to file 2 returns, or you get the money back, so there's no return needing to be filed to get your money back? There is a certificate that's being issued, I believe, from the IRS, which allows.
Yeah. So your obligation, if you're selling U.S. real property, you've got an obligation to pay any U.S. tax on any gain you have, federal and state. You got an obligation to file tax returns to report that transaction. And to the extent you pay any dollars of tax, federally or state, on the gain, You then get what's called a foreign tax credit. There's no real carryover. It's just in the same year as a Canadian, when you report that same gain on your Canadian tax return, if you paid $150,000 of US federal and state taxes, you get to reduce that generally dollar for dollar in your Canadian tax return. So you're not paying tax twice, but what you are doing is you're filing your Canadian tax return as you normally would, and you're picking up the information from the IRS and from the US tax return and from the state tax return as a dollar for dollar credit.
Okay. Now, have you seen, I mentioned at the beginning of the podcast, there's a lot of, in Arizona, there was 100 Canadian sellers last year, 700 this year. Is it those numbers accurate? Are you seeing a lot more work at Anderson's for these representing these sellers?
We're starting to. I mean, we're starting to work with clients both proactively as they work to sell and ones that have already sold. I mean, one of the things we're seeing over the last 3 or 4 years is people that sold property and didn't know or didn't go through the steps to get everything lined up. So they don't have taxpayer numbers. They filed a tax return that wasn't accurate. The tax slip with the name of the seller didn't match the tax return, and it gets held up at the IRS. And unfortunately, these stories are true because we've worked with them. If it's not done properly, it can take years for the IRS to process that tax return and get you your refund. I mean, in my 20, 30 years doing this, we've never had a situation where the individual didn't get their refund. They always get it in the end. It just takes a lot of work and time. And if you have anything that doesn't match up, the IRS will hang on to it. They'll try and, process it later, but it often involves us contacting the IRS, writing letters, getting power of attorney, contacting the IRS, what's called the taxpayer advocate service, or because I'm an ombudsman that can help you work through that. And there's a lot of time and effort, professional fees and delays to get that refund. And I always tell clients is that if you can line things up, and we work with a lot of clients to do this, where you have the taxpayer number in advance, you have the accountant kind of review the escrow documents to make sure they're tight and they're closed. You calculate that gain in the different currencies, before you file the tax return. You file the tax return as soon as you can when the forms are issued in the new year. If you can, you electronically file the tax return. If you can, you use what's called a direct deposit for that refund. If you can line all those things up, you can chop the delay in getting your refund from years down to months, down to, in one case, I had it in 45 days for a client. So there's a lot of steps involved. And what we found is it's, very kind of nuanced and detailed with the IRS and working with them. And they're very particular. And if we miss a step, if the client misses a step along the way, that's what's going to drag things and delay things. So it takes more effort and work to this, but the benefit is making sure it gets done and gets completed on a timely basis. And that's the US piece. Canada's got its own sets of things they do, and happy to kind of answer that too.
I guess what I've seen is there a deadline that you have a required amount of time to file to try and get that 15% withheld? If you waited a year, 2 years, and of course, once again, we see this. People are unorganized, and that's why we bring on professionals like Steve to make sure people get these things done properly the first time. But these stories are out there where people work, 24 months later, they're still trying to get that money's back. What do you say to those folks?
Well, we try and do our best to accelerate that. I mean, oftentimes it's communication with the IRS to understand what happened or what went wrong, whether they had missing information, or the tax return wasn't prepared properly, or the escrow documents didn't line up. We're trying to go back and get that proof. We'll often work with, as I said, something called the taxpayer advocate service to it's a separate division of the U.S. government. It's separate from the IRS, but they have the ability to speak to the IRS to work through it on a kind of a case by case situation, and it can take some time too. But you're using every technique and strategy you can to go through that process, and it does take some time, certainly. And the more accurate, the more efficient we can be at the start, the better we can be. I mean, you asked the question about deadlines. If you just look at a 2025 sale, that tax return federally would be due June 15th, 2026. That's the typical deadline for a non-resident, a Canadian who's not a U.S. person, to file a tax return in the U.S. if they're going to make a refund request, they generally have 3 years from that due date. So in theory, they'd have till June 15, 2029. So they got time. The problem is if you miss that by a day, the IRS won't refund you the money, even though they owe it to you. There's a 3-year cutoff from that. And so you got to be really mindful of that deadline to make sure that you fulfill the obligations there.
So we're getting a lot of calls every time we have these podcasts, and this is going to be one of those podcasts where we'll have a lot of people call in. So you have offices in Vancouver and Calgary. Do you have any problem servicing a client who's in Ontario that's sold their place?
No, we're registered in every province across Canada, so we can handle clients all over Canada. The unique thing we want to try and do is work with them. And so a lot of clients will have their own Canadian team, and I think that's great. We want to keep working with that Canadian team, but they may not have a U.S. solution. And so we can work with the Canadian income accountants to prepare the U.S. tax return, to get it filed, to coordinate what that means from a Canadian perspective, translating Canadian dollars. What's the foreign, exchange gain? What's the foreign tax credit? And then even, the one piece down the road is inevitably what we find is Canada Revenue, when they get a tax return with someone who's got a fairly big capital gain and claims foreign tax credits, they'll do an audit. And the audit isn't of the entire tax return, but they'll focus on the foreign tax credit and say, oh, we see you claiming a foreign tax credit. You've never done that before. Give us proof. And they want, the proof's quite extensive. They want copy of the tax return you file. If it's a state return, they want a copy of the state return as well. If you've got checks you've written to the IRS or the state, they want those too. The biggest thing they want is what's called a transcript or a notice of assessment as we think about it here. They want proof that you actually filed this tax return and that the IRS or the various state governments, that they assessed it and produced something. And that's unlike Canada, where Canada Revenue just gives notices of assessment kind of within 45 days of assessing a tax return. The IRS doesn't do it that way. The IRS will only send you a letter if there's something wrong. So if you file the return and it's assessed as filed and they, accept the tax and everything works, they won't send you anything. You have to go in and actually request that transcript, because that'll be the proof you need for Canada Revenue when they come kind of with the letter saying we'd like proof. And Canada Revenue often only gives you 30 days or 60 days to get that proof in. So when we work with clients, we want to make sure that we can kind of file that U.S. tax return as soon as we can in the new year for individuals. And then when it's done, we want to give them instructions, say, okay, here's how you request that transcript. Doesn't cost anything, but get it done sooner, because inevitably in the spring, when your Canadian tax return is assessed, you'll get a letter, it'll want proof, and we'll want to kind of line these things up. And we've been talking 30 minutes or so, you can hear there's a whole bunch of pieces on this. And if it intimidates Canadians, I hope it shouldn't, because this is a process, we work well with, and we're happy to get involved. And, know that we've had a lot of experience doing this over the years, and we got a lot of ideas on how to make this as efficient, as effective as we can.
Okay, here's the last question. I saved the toughest question for the last, and I appreciate your time, so I'm going to be very
sure.
Dealing with an estate. The surviving spouse passes away. The estate, it's basically an estate sale in the States. How common is this when people have left everything for the end, and now we're trying to sell that property because dad has passed away, and it just seems like very complicated.
So this would be a deceased Canadian who owns U.S. real property.
Correct.
Okay. So it's a lot of the stuff we talked about is still going to apply. I mean, oftentimes those estates, or maybe the properties in a trust, depending on what the will said, it'll be a Canadian trust or a Canadian estate. The same concepts are still going to apply. There's still going to be withholding tax. There's still going to be a need to file tax returns. The tax rates are probably similar in the U.S. for estates, compared to individuals. So the same process still applies. It's just going to be a different individual. It'll be the executor that's going to have to transact that and help do that. And we've worked with those situations before too. So.
Well, Steve, I know that I've taken 7 minutes more than we had planned, so I appreciate your time. I wish we did give away green jackets, blue jackets, red jackets.
Well, this was the joke I had for you on Saturday Night Live. When you've been a guest host for 5 times, you get the 5-timer jacket. And I look forward to getting mine.
Yeah, well, you sure hope you get invited for the 50th anniversary.
Can't wait.
guest plus one.
Perfect. I'm in.
It'll be crowded. But I appreciate your time, Steve. I enjoy working with you. I enjoy your expertise. And so thank you very much again for your time. And once again, if you need to get hold of Steve, you can reach there. Anderson has an incredible website. Steve's located in Vancouver here. He does travel to Calgary quite a bit. You can get a hold of us through, get a hold of Steve through us, or they can contact Steve directly. We're here to help. We're here to connect people with the right professionals, and Steve is high on our list. So, Steve, thank you very much.
Thank you for the opportunity. Appreciate it, Gerry.
Thank you again for listening to the Snowbird Expat Radio podcast. The best way you can support the podcast is to forward the episode to a friend, and please don't hesitate to like, subscribe, or leave a comment. Now, before you go, let me leave you with one of my favorite quotes. Be kind to all, the world is small.